So next question, question number 60. This is the same question. Okay, students, so you can read the question, pause the video, and you can do this question yourself. Okay, so then we'll compare the answer. Okay, students, so hope you have completed this question. If you see, everything is same except there are 8 zeros here. So 4 zeros are extra. So step, okay, so everything is same. And if you see, they didn't tell you here that whether you have paid the interest or paid the principal. You get an impression that they renegotiated the term. But have they told you in the question, study material question, that only interest is paid, not the principal? Question is very silent. Anyhow, we have taken that assumption. Okay, let's see in the examination what happened. In December 21, this question came. Coupa Limited borrowed 95 lakhs. And interest rate of 10%. Coupa spent processing fees. Principal to be repaid in 5 installment. EIR is 10.8. We understand it. 31st March, Coupa faced the challenges. It approached bank and renegotiated. Interest rate changed to 15%. Principal amount is paid in equal installment. And the interest is to be paid up. Before approaching the bank, Coupa Limited made the payment of interest. See how beautiful clarity they have given in the examination question. Study material simply confused, no? Then you can tell, sir, in study material also they could have given. You should say, why I should give. Look at the solution. Followed? You are required to record the journal entries till 31st March. After giving effect, working should form part of the answer, terms of the loan. They have given you 3 particular rates with the 8 years. So be careful. Now you don't trust anymore, no? You will be very careful. And you know one more thing, funny thing. One of the rate was wrong in one of the examination in AFM. One of the rate was wrong. What you should? Both are okay. You can take your own rate if the rate is found to be wrong, or take the rate what they have given. Institute is going to award both the marks, but in the suggested answer they will show you only one, the corrected answer or whatever it's, God knows. But B, okay, that's okay. We can always go for the thing what they have given us. That's not an issue. Yes, so we'll check the solution. Bank is amortized cost upfront 587 is adjusted, means 5 lakh 87, 58 lakh 70. So contractual cash flows is what we calculate. This we have done already. So students, you must have got these numbers. This is my contractual cash flow. Amortization schedule I cannot prepare along with this because of the opening balance adjustment. Then we prepare the amortization schedule where opening balance is going to become 49 lakhs 41,000 49 crore 41 lakh 29 204. Then I will come back to the closing balance. These are my CCF. I hope it's clear. You have done it properly. If you want, you can pause the video and cross verify, and in PDF also that answer keys are available with you. Then journal entry I'll pass, cash to loan, loan to finance cost to cash. Normal entry from amortization schedule. But the second year I will pass the entry 31st December, finance cost to P&L account, but only I'll pay interest portion. That's why my loan balance is going to increase now. Then assume the negotiation model. Okay. No, this I copied from the previous thing. Not required because study material question assumption is required. Examination question, this assumption is not required. Then we have to do a substantial modification test. For this, I want the present value of the cash flow under new terms, but I start with 40 lakhs only because this is my contractual cash flows. This is the contractual cash flow. But when I find out the present value at the old EIR, I get 45 lakhs 15 22 781. Okay. Then what is my PVCF of the old loan? Is the closing balance plus the premium, the installment what you didn't pay, 39 74 89 650. Yes. Now you prepare substantial test. It comes to same 13.6% because the same question. You say that we have to perform substantially. When you write in the examination, that was my example, one line. But here you write proper thing. What exactly you are going to do with the loan. Calculation of the fair value not required because loan is the principal amount. 40 crore itself is the fair value. The adjustment factor will be 25, 10, 350, which is nothing but unamortized cost of the transaction price, transaction cost. So the last one is the transaction entry on 31st December 2012. This is modification, extinguishment, old loan debit, new loan credit, loss will be debited. Next year, bank loan 15% debit, interest expense to cash. Yes, I hope you have got this, friends. Yes, next question we will move on. Oh, it's the same question. I want you to solve now. There I have put it just to show that, look, they will give you that in the examination. Yes, so again pause the video, students, and this time you also do it here only, right now in the class, so that you get an experience. Previous question, since it's the big no, it's going to consume time. Okay, at home you can do it, students, because it's a practice to you. But I want to solve you this problem. Anyhow, I have read it already right now. Yes, students. So this question has come for how many marks? Sorry, 12 marks. Is this question conceptual or procedural? Is this question a conceptual question asked in the examination, or procedural question which is asked in the examination? What is the difference? What the difference is, if somebody has practiced the study material question thoroughly, will that person be able to solve this without understanding what it is? The chances of that person getting marks is very high. Why? Because is there any twist? Numbers, format, everything is same, no? So to pass the examination, my point is same. It's not required that, okay, only conceptual is needed. But we really don't know. Again, we have to make one research there, that in every examination, how much portion is the conceptual, how much portion is the procedural. But the procedural portion is very low. So this problem can be attempted by anyone who have studied the study material question thoroughly. Day in, day out, practice same. Even numbers also they remember that. Then that person can solve. But conceptually, if I twist there, if I bring one element that, okay, on so and so date, the rate of interest was so and so. Go on. So you understood the difference. So what you need, conceptual or procedural? Procedural is fundamental, that you have to learn anyhow, but you have to go to the next level. So initially you start learning procedure. No, I teach you procedure only. Oh, this goes like this, amortization is prepared, this value comes from there. It is how. How is a question which answers the procedure. Why is the question which answers the concept. So when you are solving, ask yourself, now why this rate? Why this has to be added with the market rate of interest? Why I have to find out the fair value? Followed, no? That makes you very strong and powerful. Actually, conceptual learning takes more time. Procedural learning is very fast. Chuck, chick, chuck, finish. Procedural. Conceptual means you need to spend more time with yourself, with your studies there. Okay, so I don't think so there is any catch here. Okay, straight away we can try to compare the answer. So first thing is you prepare an amortization loan. Okay, so where you started with the 95 lakhs. Okay, what is this 95 lakhs? The principal amount itself is, loan itself is 95 lakhs, correct? So you started with a loan of 95 lakhs. Cash outflow, that payment, okay, we can include. This is what we start with, opening cash flow. Principal, 5 equal installment. Interest will be at the rate of 9,50,000. See, this is what suggested answer has given. What they have done, they have mixed both. We have done two separate workings, where contractual cash flow is a separate working. EIR, see, amortization is separate. But they have mixed amortization and your contractual cash flow together. Understood the difference, no? So up to here it must be working note 1. Did you get 2850, 2660, 2470, 2280, 2090? Did you get the interest in the next working? 10,06,000, 8,07,000, and the closing balance becomes 0? Yes, you are done with the first part of the work. Then you pass the entry 93,19,088 bank to loan. Then the first year loan from bank 18,43,000, interest expense 10,06,000 to bank. If you see here, they never told P&L, They didn't transfer to P&L. Why? Because this entry is not journal entry focused. Should make the difference. There are some questions where a journal entry focused question, calculations are very minimal there. Then give the detailed journal entry, transfer it to P&L account. You follow? No? Have you observed this institute? Some places they have done, some places they have not done. In AFM also, some equations they have explained the equation. Some equations they simply wrote the equation and solved it. What is the difference? If a problem is equation based, explain the equation. You will get the marks for that. Problem is not predominantly equation based. Don't explain the equation, write it, go. If the problem is predominantly narration, journal entry based, then give a detailed journal entry. Here, no. See, that's why where they are told that interest expense will be transferred to P&L. Not told. Okay, did you get this? And then you pass this entry, interest expense 8,07,000, bank 7,60,000 and 47,359. Then some story comes that, oh, there is a modification happening, recomputation should happen. So fresh modification, so we have to perform substantial modification test. You perform the substantial, you need the PVCF under new contractual term with the original EIR. So first you calculate the PVCF. This is your PVCF 2019, 1947. Did you get this? 1805, 1662, 515. This is what, if I am an evaluator, I will just look this. Then I will present value factors. They have already given 10.8. Did you get 86,42,768? See, everyone should get the same answer here, huh? Because you can't take any other present value factors there. And we have done a separate working, but what they have done, they deducted the carrying amount of the loan here. What is the book value of the loan? Book value plus that whatever. Did you get this 75,22,909? Alternatively, you go back to the amortization schedule. This is your book value. Add that interest portion. Oh, sorry, the principal portion. So did you get, students, this 76 lakh and 14.89 is the modification? Everyone got this number? It's what went wrong. In mistake in? You took it as an transaction cost as a? What you did with the transaction cost? What did you do? Okay. Amortization. Anyhow, no problems. Again, you have to figure out, see, this is an examination question. Which question first, not compulsory, no? Compulsory question. See, you have a choice. And which question they asked? The most tricky question there in the study material, modification. They asked as a compulsory. So you should realize, and again I told you, repetition can happen under new syllabus, but new syllabus can be more conceptual because they have reduced you to subjects. They may, see, this same question, I can make it a conceptual question. Simple. What is the difference? Add one, last time elaichi is added, no? This you put one chakke or whatever, that another thing you add, finish. This becomes a conceptual question. Followed, no? Anyhow, you have to practice this. Now, decision making, since it is more than 10%, new loan shall be accounted as a separate liability, or you can call it extinguishment accounting, your version of the story. Next, if the entries will be there, then loan account, see, then again we no need. I just showed you for the sake of your understanding. But actually your fair value and all same. So you say new loan account, old loan is 75,22,909, new loan is 76 only, and the differential will be the finance cost. This is the what they have done. Accounting entries. Oh, the loss of modification, they have transferred it to the finance cost. Followed, no? Doesn't matter. You could have transferred and given the explanation. Next year, 95 lakh 50, 11 lakh 40, and the bank 20 lakh 90. Perfect, students. Nice, no? Okay. With this, we are done with the, actually 2-3 questions only and one examination question. With this, we are done with the derecognition of the financial liability. We understand how important it is. Now, there is one example setting, okay? Anytime, again in your new syllabus, they may ask you this example. It is debt equity swap. Debt equity swap, what you need to do? You need to de-recognize the debt, recognize the equity. Very simple. Debt account debit to equity share capital. But if you don't do it full 100%, then partially you do and partially you renegotiate, then you have to apply modification test for the balance portion. The gain or loss should be recognized in the P&L. Okay, so let us take example, question number 62, which is nothing but an example number in the study material. Now, JK Limited has an outstanding secured loan of 90 crores to a bank. Is this 90 crore present value of future cash flow? Why not? Because it is a debt. It is a debt. When this loan taken, God knows. Whenever they took the loan, they must have found out the present value of the future cash flows. Since up to in the first sentence, it is an at the market or off market. I don't know, whatever it is. But outstanding balance, where do you find? Amortization schedule. If I ask you what is the outstanding balance of the loan, you say, sir, please look into the amortization schedule and you will tell me the balance. What is the meaning of that closing balance? Present value of the future cash flow, no, at whatever EIR, I don't know. So what I can assume that 90 crore is the present value of the future cash flows at EIR. At this point of time, I don't know. The effective interest rate is 10%. That is, if I take it 10%, present value should be 90 lakhs. Owing to the financial difficulty, they are unable to service the debt. They approach the bank for a settlement. Yes, Prithvi, what is your understanding? Whatever it is, a final amount, but today outstanding balance is how much? And when they are supposed to pay? God knows, no? As I told you. So at any point of time, see, when you have got a bullet loan, you pay every year interest. Outstanding balance at any point of time is what? 10 lakh rupees. But if it is an off-market term, no, then this is a different story. So I am going to assume it is market terms. Now the bank offers the following terms which are accepted. They said, look, 2/3 of your debt, that means 90 has got 60 and 30, is unsustainable and will be converted into 70% equity interest in JK. So 60 I will convert, that means straight away debt account debit is 60 to equity share capital. But at what value? Debit 60, book value goes out. But credit should happen at the fair value of the net assets, no? But the fair value of the net assets is 100%. How much you got converted? 70%. So 70% of 80 to equity share capital. Difference is the gain or loss. Now that what about that 1/3? The debt is sustainable and the bank agrees to give moratorium period. Modification is going to happen. And decrease in the interest rate in the initial period. The present value of the cash flow as per the revised term or a new term or PVCF as per new term using original EIR is 25 crores. Why do I need this? Substantial modification test. If I had to perform, because they said there is a modification. For this I have to perform substantial test. To have substantial test, generally I first working notice present value of cash flow, new terms at original EIR, which they told me in the question. This versus what is my present value of existing, that anyhow I know. And the fair value of the cash flow as per the revised term is 28. If at all extinguishment is going to apply, then old loan 30 I have to de-recognize the second portion and new loan of 28 I have to recognize, which, see, I need not do any calculation, everything they only told me here. Fair value of the consideration paid is 56 crores for that asset related plus 28 crores the debt, that is 84. That means there is a 90 goes out. What comes in? A new loan of 28 and the share capital of 56. Perfect? Yes. How to account this in the books of JK? So for the first portion, 60, no, full extinguishment accounting. There is no test required. What test required? It's gone, no. But for the second portion, we need modification test. Okay, write the solution. In the given case, two-thirds of debt, 60 crore, we apply extinguishment accounting. In the given case, 2/3 of the debt we are going to apply extinguishment accounting because it's gone. For balance 30 crore, we apply substantial modification test to decide what accounting we need to apply. First one I need not apply because I know that 60 crore straight away you extinguish. But for the balance, you are going to apply substantial modification test. Yes, let us do now substantial modification test. For doing this, I need certain information. Is it available or I have to calculate now? It's available. So percentage of modification. What is my PVCF of new at old EIR? 25. Minus what is my PVCF of old at old EIR? Yes, Prithvi. PVCF of the new EIR, if of the new cash flows. New EIR is 25. What is my present value cash flow of the old terms under old EIR? Hmm? 30. Because 90 is what? Present value of all the future cash flows at 10%, no? So 1/3, 30 divided by 30 gives me 16.67%. Yes, the modification is substantial. So what we should account in? Extinguishment account. For the first one, not required, 60% not required. So right, since modification is greater than 10%, we apply extinguishment accounting. We apply extinguishment accounting. Second, what is my gain or loss? For this, first I will find out the book value of loan, what goes out, 30, minus fair value of new loan, 28. 2 is my loss. Are you clear? This is very simple, no? You wish this should come for your exam. It has not come till now. They may ask, but not more than 5 marks. But there is nothing much, you know. Huh? Sorry? Entry we have to pass. So loss on modification is 2. Then we will pass the gain or loss on debt equity swap also. This is where 30% we said, modification of the loan we made a gain of 2. What about the debt? Book value of the debt swap is 60. How much equity you give? 56. So you made a gain there also. In short, you can give one single combined working also because they only told in the question. What went out? 90. What you gave together purchase consideration? 84. They told no in the question. Which one? Okay, yeah. Okay, so yeah, your question is valid. Your question is, why do we transfer this to P&L account? Because on conversion of the debt into equity, we don't do that. This is what we are seeing. Yeah, but probably that is for your compound financial instrument. When you have got an option to convert, and you are converted or not converted. But here it was not an option. It is like a settlement, one-time settlement. It's like you have given your net assets to somebody which was not plan of the original. Because see, what happens in debt equity, what happens in the compound financial instrument, on day one only somewhere something passes fixed for fixed test. You convert at how many shares? Fixed only. On day one only you know that, even though you convert. But here what happens? Here on day one, did you had a plan to convert into equity? It was never part of your scheme. You just took a loan. All of a sudden, it happened that there was a modification, because of which your debt got converted into equity. So it was never equity before from the beginning. It was always the debt from the beginning. Right now it got converted, but in your compound financial instrument, it was always from the beginning, it was an equity. But good, I'll show you the journal entry and I'll show you the what solution ICA has given. So my old liability will be debited 90. Equity share capital will be credited 56, and if they give me the face value, number of shares and all, I would have given the breakup there. Share capital is how much, my this is how much, premium how much. Gain will be 4 plus 2, 6 you can write, because both will go to P&L, or you can write gain on debt equity swap 4, modification 2, and the new loan will be 28. So now you are clear why we are taking it to P&L account. Yes. Now I'll just show you. See, this is an example. Okay. In fact, they didn't ask the question also. If you look at the ICA solution, this is what they have done. They said that, look, this is 2/3 is going to happen. I'm going to apply substantial test. 4 crore profit I will take to P&L account, and balance of not extinguished. Difference will be 2 to the P&L account. In fact, journal entry and all, they didn't ask you. I'm doing it because examples comes like that only. And in examples also will be asked. So whatever highly probable examples I have already given to you. Yes, sure. So now with this, we will move on to the last aspect of your financial instrument, which is hedge account. There is nothing, it's theoretical. There was previously one question was there. Now they have, it was appearing in an MTP. New study material they have not updated, so I will not consider it important right now. For your academic interest, I will share it with the solution. You can always, after you get a hold over this, you can solve those additional questions. What is hedge accounting? Hedging is a making an investment in derivative or non-derivative instrument to offset the potential losses on some items as a particular risk. That means you import, you got into an exposure of foreign currency. Anything can happen. For this, you go to a forward market and buy one forward, finished, you are hedged. So you take an opposite position in the derivative market, that is your hedging, or non-derivative also can happen. Follow? Now you have got a kid. Kid's education is a problem. Is a risk? Yes. 10 years down the line, what is the education? What I will do? How do I hedge? Buy one land today, and have in your mind that this land is meant for education. Finish. You are hedged. So what you did here? You took a non-derivative to hedge your risk, because land values are going to appreciate. And somewhere, see, it may not be a perfect hedge, but somewhere it gives you hedge, no? Eventually, or simple, you take one insurance policy. Finish. That is also a best hedge. How much cost? Okay, 50 lakh rupees you want. 10 years down the line, take one insurance policy, start paying. Endowment policy you take. So finish, you are bound to get that 50 lakhs. So hedge accounting is an optional thing, it's not compulsory. If you want, you do it. And if you plan to do it, then you take that option of FVTPL, mismatch accounting. Then comes your picture. Otherwise, if you don't want to do, then why you want to bring something into FVTPL? So if hedge accounting is not opted, there will be some accounting mismatch. So if you want to set it right, then bring it. All gain or losses from your hedging instrument will be recognized in the P&L account. However, the hedged item are measured at a cost, amortized cost, or FVOCI. They are not recognized in the balance sheet, because that differences will be capitalized. Changes what is happening in the amortized cost will be sitting in the balance sheet. But if you have taken a derivative instrument, it will go to P&L account. That's why that mismatch is going to happen. I told you, no? Mismatch part. With the hedge accounting, you can show the readers what the risk the entity is facing, that performs certain risk management, what risk management strategy I perform, and what is the effectiveness of that strategy. See, if I don't do this hedge accounting, then I may do hedge in reality. I do import, and I will buy one forward contract. Did I hedge? I hedged. But the import related exposures will go and get capitalized there. It will sit in the cost of the solar panel. Say for example, if from USD I purchase dollar only, is there an embedded derivative? I imported from USA in dollar. Is there any embedded derivative? There. Should I separate? No. Why? Why should not I should not separate? Which test fails? The question is clear. If I from USA, if I import in dollar, is there any embedded derivative? Answer is yes. Because that dollar import results into variability in the contract. And second question I'll ask, should I remove it? You say that, sir, let us apply 3 tests. Will you take that import into FVTPL? I say no, Baba, what import into FVTPL? I will capitalize it. Second, you will ask me, sir, this forward currency, what is sitting forward, no? Is it past derivative? Yeah, it is passing derivative. So both the tests fail. Then I'll say, go to the currency test, economic characteristics. Is this the currency belongs to one of the functional party? Yes. So then why you, that means the economic characteristics make sense there. You don't want to hide anything. So I don't want to separate it. Followed, no? So since you are not going to separate it, okay, that where the effect is going to come now? If the forex rate is going to increase, it will go to the balance sheet, because that if the forex rates are today, forex rate is 60 rupees, you are bringing $1 million. You don't separate it. Tomorrow it becomes 65. So how much you need to pay to him? 65. So you pass the entry solar panel capital asset account debit to vendor 65. That 5 rupees is capitalized and sitting in the balance sheet. To hedge it. Did you hedge it? Yes. In reality you hedge it. How? You took one forward contract. Is this forward contract a derivative? Yes. The difference between the MTM is going to go to P&L account. So how much is your loss here? 5 rupees is the loss. How much is the gain here? 5 rupees is the gain. One leg is sitting in the balance sheet, another leg is sitting in the... See, you have done fantastic hedging. In reality, the truth is you have done hedging. But are you showing that to the readers? You don't do it. That's why you do hedge accounting. And to do hedge accounting, you take that FVTPL option and all. So that you demonstrate, look, I have not allowed that impact to go to P&L account, I have matched it. Followed, no? So this is called hedge account. So with this hedge account, that's why it's optional. You want to do it, you want to demonstrate, you do it, otherwise leave it. Because you need to have a documentation, you have to prove it, you have to specify what is a hedging instrument. Simply you cannot fool around people. So this is the original purpose of the hedge accounting. Why you want to do hedge? You tell the readers, look, this type of risks we are addressing. In fact, with the hedge accounting, P&L account is less volatile. Otherwise, it is volatile. One leg is there, another leg is in the P&L. P&L become like this, no? Now, by hedge accounting, you normalize that P&L account. You say, look, I have got that account. Okay, so we will not go more deeper because it's actually a subject matter of expertise, I can say. So much deep depth is there. We'll just understand how much to write in an examination. So, in the principle, have you understood the concept of hedge accounting? So, what should I do? How there? There are 5 steps in hedge accounting. Step number 1, identify the hedged item. What do you want to hedge? You have to identify it. Second, identify the hedging instrument. It can be a derivative or a non-derivative. Always the hedged item will come first. Then hedging instrument will come. Hedging instrument come first and then hedging meaningless. Because these are all speculative things. The moment you enter into a speculative thing to offset a position, it becomes a hedge. It will kill. But that is possible only if there is a hedging relationship. No. Now your child's education and land, is it having any relationship? Will the cost increase in the same way? Then what type of hedging relationship you are establishing? Otherwise, do one thing. No. Cost of education is on one side. This is my hedged item. What is my instrument? There is one education index, cost of education index. Say for example, it will show you how much every year. Take one call position, no? Long position you take. then it makes sense, because your Reliance Industries is importing oil in dollar, say for example, and to hedge it, it has purchased the gold. What you are trying to relate? So if you want to hedge an import in dollar, go and buy one forward dollar. No sir, I will buy one Chinese yuan to hedge this. So there is no relationship, no. That's why you have to evaluate the relationship. What exactly is an item? What exactly is the hedged instrument? Is the underlying same for both? Then decide a type of hedge. There are three types of hedge called a fair value hedge, cash flow hedge, net investment hedge. Like education, are you looking one-time donation cost or are you looking every year fees? It is one-time donation cost, I will call it a fair value hedge, market value. If it is a cash flow every year, I call it cash flow. See, fair value versus cash flow are opposite to each other. If you focus on cash flow, fair value will go for. Like you go to the bank, you say, sir, I want every year interest in my credit. Then at the end, he will return you 100 rupees only. The moment you focus on the cash flow, you don't get the fair value. You say, sir, I am not interested in intermediate cash flows. Then he will return you 180 rupees. So if you are not focused on the cash flow, fair value will increase. If you want to try to protect cash flow, fair value will go for a toss. One among the two you can touch. At the same time, right now, it is impossible in this world to protect both. I want market price also should protect it. So that's why organization should decide and prove to the auditors what they want to, because accounting is going to change now. The last is you have to perform the hedge accounting, pass the journal entries. So hedged item can be an asset, it can be a liability. You have taken one external commercial borrowing, liability. You are going to import one solar panel, asset. Oh, sorry, not an asset. Any asset it can be. Investment, you have invested in USA, problem. Returns are coming in dollar. Dollar goes down, your investment value also goes down. Unrecognized commitment, purchase order. You have placed one purchase order to import. Forecast transaction. Now you are thinking that next 6 months, my fuel consumption is so much, one airline industry. They are worried about the fuel price increase. Net investment in foreign operation, that you are subsidiary in a foreign country. So all these can be an items, which is a starting point for you. Your child's education is an item, which creates a risk for you. Now it can create a fair value risk or a cash flow risk. Now identify the hedging items. Now when you identify the qualifying hedging instrument whose fair value or related cash flow should offset the changes in the item there. Simply don't go and pick anything, meaningless things. So qualifying instrument can be a derivative or it can be a non-derivative. Like you can get into a money market hedge. Money market hedge is also an effective way, but it is the non-derivative one. What's the money market hedge? Have you heard about it? Okay, this is one of the hedging strategy where suppose if you are going to import from USA, 6 months down the line you have to pay, no? Do one thing, today only you go and make one deposit there to the equal to the present value of the future cash flows. And at the end of 6 months, ask the banker to pay to you, finish. Is it a derivative hedging? No, it's a non-derivative hedging because you have made an investment there, which is equal to the present value of the future cash flows. So a qualifying instrument can be both. If anybody asks you an example, you need not learn in depth, but conceptually interconnect the subjects and tell. Now evaluate the relationship. So you have to check all the three criteria are met. Hedging relationship consists of only eligible instrument and eligible items. That means you need to have a policy in the organization. What you want to hedge, what you don't want to hedge. Like your parents should have a policy. Education, I want to hedge. Health, I want to hedge. I want to buy a car. Okay, I don't want to hedge. Then, and there should be a formal designation and documentation also. What you have policy should be documented. And it should meet all of the hedge effectiveness, that the economic relationship between the item and instrument should be offsetting. Like import dollar, forward dollar. Import in dollar, forward in euro makes no sense. And credit risk does not dominate the value changes. That means what is the dominating factor? It should be the underlying. The credit risk should not impact much. and the entity maintains the same hedge ratio. Okay, hedge ratio includes your, say, if you are importing $10,000 worth of import, one future contract is $800. Then you have to buy 12 contracts. So the 12 contract into $800 will help you to cover up that 10,000. Don't simply go and buy $10, 10 contracts. 10 contracts will not cover your 10,000 imports, because 10 contract will give you $8,000. But how much you need minimum? 10,000. So go for 12 or 13 contracts. This is called the same hedge ratio.